All right, what's up, everybody? Welcome to another episode of Rebunked. My name is Scott, coming at you live from Music City, Nashville, Tennessee, and I got a wonderful episode for you guys tonight. It's been a while since I've done an interview show. Let me look here. It's been, let's see, I've been doing these solo casts, these explorations in consciousness since 2024. Yeah, Richard Gage, like back in like early December, November is like my last interview. So yeah, I'm feeling good, you guys. Back in the seat, back ready to rock and roll. I got a wonderful guest, fantastic conversation in store for you all tonight. So thank you for joining me. We're not gonna mess around too much here, but I do want to shout out a couple of things before we get too far here. So I do have you guys know about the Substack, rebunked.substack.com. This is where you will, if you want to help support the show as like a monthly subscriber basis, this is where you'd go. The solo casts have been posting the links to all the topics that I discuss, the show notes and everything, along with a bonus episode. So there are bonus episodes out there. If you guys didn't know, I got a couple bonus episodes on the Substack, rebunked.substack.com. But also, it's completely free to sign up. That way you get on the email list. So you get notifications about the show, upcoming live streams, all that good stuff. So just definitely go sign up, rebunked.substack.com. And then, of course, if you guys haven't heard the album, rebunkedrecords.com. The album Universal Basic Awesome is live. Everybody's loving it. It's a lot of fun. 10 tracks. You can buy the album right there, digital download, $8.99, or you can watch the videos on YouTube. You can get the link to the YouTube right there. And if you look at this, I made videos for every single one of the songs. Like, who does that? Like, these big, top 10 artists, they drop an album. They don't do music videos for every single one of the songs. Well, I did. I took the time to make a music video for every single one of the songs, and I'm super excited about it. So rebunkrecords.com, Universal Basic Awesome. I think you guys are going to love it. I've been getting lots of good feedback. Stu Peters likes it. I got to go on Stu Peters. He loved it. That was a blast. So yeah, guys, there's a couple hits on there. We Don't Need You No More featuring John Bound and Rob Dew from InfoWars. And then Unjected Gal. If you guys haven't heard Unjected Gal, it's a banger. So and then you got links. You know what's crazy is like my link tree got shut down. I was using libertylinks.io/rebunk. That was my link tree. Apparently Liberty Links went down. So I'm kind of bummed about that because every episode I've ever done has my link tree on it, and now nobody knows where to find me. So also from rebunkrecords.com, it'll take you to the shirt shop, and I've got some epic shirts in there. Grow food, buy guns. This is funny. Diversity is our strength, right? With all the different firearms right there, all a bunch of different colors and stuff. The Rebunked Records logo. So this is the first line of Unjected Gal. It says, she cooks, she cleans, she doesn't take vaccines, right? Hilarious. Great gift. Great gift. Let's see what else we've got. Okay, the other really popular one. Oh, we got the Beavis Are You Threatening Me shirt. That's been an all-time classic. That I've had that on my Rebunked shop for a long time, even before the album, and everybody loves that shirt. Oh yeah, I need to have him move this up because this is probably the most popular one. This Pfizer fuck off shirt there. There you go. So these are all the shirts that appear in the music videos. Go check it out, rebunkrecords.com. You can get a link to the shirt shop. You can order a CD too. What do you know? You can get a CD. I mean, if you listen to CDs still. So very proud of this album. Hope you guys check it out. And then let's see what else we got here. So truthtrs.com. I made this site. This is an affiliate portal. Basically, this is a heavy metal detox spray. So if you're interested in going and doing a heavy metal detox, I do have an affiliate link for that. And so if you order it through Cosiva with that link, it helps the show. And then the last thing I want to shout out, you guys, is of course Unjected, the Unjected dating app, Unvaccinated Connections. It's live in the App Store, on the Apple App Store, Google Play Store. You can download it. People are matching. We have, like, every week, it seems like we get a new success story. We've got people that are getting married. We've got, lots of unjected babies out there. There's a couple that lives about an hour south of me who met on Unjected, and they got married in 2023. They have a baby now. It's just like the most miraculous thing ever. And brand new, we have the new Unjected swag shop. So unjectedswag.com or store.unjected.com. We've got men's shirts, women's shirts, all kinds of fun stuff. So like with the men's shirt, we've got the unvaxxed sugar daddy line. Okay, right. Got the regular Unjected logo, single and unvaxxed, right? If you want to just wear it loud and proud, and women's shirts too. Where's that one? I like this design right here. Single and unvaxxed, ladies. Come on now. Let the fellas know what time it is. And then this is really funny. So we have these. These are brand new, you guys. We have unvaxxed sperm certificates. So this is a diploma from the Unjected Institute of Freedom, the Department of Unvaxxed Legends, unvaxxed sperm certificate. On recommendations of the faculty, the Board of Critical Thinking confers upon the holder of this certificate the honorary title of Unvaxxed Legend with intact DNA. And it's signed by Unjected. And it says, granted under the seal. Oh, here we go. Yeah, there you go. Now you see a little better. Granted under the seal of the Institute from this day forth, be fruitful and multiply, right? So you got your unvaxxed sperm certificates. And then, ladies, we haven't forgot about you. The unvaxxed babe certificate, right? The honorary title of unvaxxed hottie with intact DNA. So the great gifts items. They're fun gag gifts. They come framed or unframed, or you can order for $5 little postcards. So you can hand these out, right? So lots of fun, lots of good stuff. So, all right, guys, thank you so much for that. I really appreciate you hanging out for the business side, and really excited about my guest. I heard him on Owen Benjamin's stream, wrote in a letter describing what he does and what he's all about. And I was like, wow, I got to have a conversation with this guy. So I want to introduce Hans Tui. Did I pronounce that right? I'm sorry.
Yeah, that's it. Yep.
Okay. Hans Tui from Remnant Finance. And he wrote in his letter like a harrowing story about battling the establishment. And that caught my attention in addition to, what he's doing now, like how his life took a course correction from what he was doing before, and he landed in a new realm. And it's like, I want to start there because I had that exact same experience, man. Like I literally was working as a drug and alcohol counselor back in Oregon. And I was like, okay, trying to work my way up to the company at this agency. And then when COVID happened, it was just catastrophic. Like everybody was just, the whole masking. And then eventually I knew it was coming, but they required everybody to take a shot in order to keep their jobs. And I said, nope. And so that job went away. But then out of that, I completely, like, my whole life felt like it was being derailed at the time, but little did I know I was actually being put on the tracks that I was meant to be on. And so, I can't even imagine that I'd still be in a freaking office in Eugene, Oregon, like doing that job for like no money at all. And it's like, so grateful for that in a lot of ways, and in every way. Like, I'm just so grateful for that. But so let's go back in time to what your life was before all this. So tell us like about your background in the military, right? In the Navy, is that right?
Yeah. Thanks, man. Appreciate the intro and having me on. I got to say that doing drug counseling in Eugene, Oregon, harrowing is probably more accurate on your former life than mine. At least post mandate. Once the mandate dropped, my career got very unharrowing. It just became a bunch of administrative and legal bullshit. But so I've been in the Navy my whole life until this past June. I was ROTC in college and then commissioned, went to flight school, and I flew helicopters for the Navy for about 11 years. Had an awesome career. Without getting into the pointless details of how our career progression goes, I was on track as a top performer in my community for my specific type of helicopter. I had always planned to do 20 years. My wife and I were planning to do the full military. You get to 20 years, you get the pension, you get the healthcare for life. Like that was just part of our plan. That was who I was. It was something we had never questioned before. And I was fortunate. I did a tour, my last tour on my initial contract, which took me to about the 11-year mark. I was doing a grad school program. I was in Cambridge, Massachusetts as essentially a civilian. I was attached to the ROTC unit there, but I had no overlap with them apart from just being administratively part of their unit. I was for the most part a civilian, but doing a military tour, which was an awesome experience. And so I'm in grad school and I'm watching everything from afar. And I am very blessed compared to my peers who were actively in the Navy and at squadrons. All of the pressure, all of the lies, the manipulation, the coercion, everything that we all experience in our various industries and fields, I got to watch that from a distance, and I saw what they were doing without really getting any pressure on me because my classes went virtual. So we were just traveling around New England, having a great time. I knew the mandate was going to drop at some point. At this point, it was just coercion, manipulation, trying to get as much compliance as possible. At the same time, my wife was pregnant with our first, and she did a deep dive into health and how do I prepare myself best for this baby. And so we both kind of came to the same conclusion through these two avenues. My wife from the natural birth, the healthy labor, like all that stuff that she did a deep dive in. And I'm looking at it from the COVID side and seeing what was happening with that. And I did a deep dive into vaccines, and we both came to the same conclusion. We are out. Like we're not participating in any of this medical model, whether it's birth, whether it's the, outside of trauma and the stuff that is reasonable. Like I don't want to be so extreme that I'm just never going to do anything with medicine. But I lost all faith in the institution, the medical institution. And we both decided that the best way forward was, a natural birth, not getting our baby injected with anything, still hasn't been.
Amazing.
Yeah. And so then the mandate dropped, and I knew that it was all bullshit because by this point I had been plugged into a network and knew that the headline that they were going for, which was that we have an approved shot, which is why we can now force people, because before they couldn't force it until it was approved. We knew that it wasn't actually approved, that they just did a sleight of hand, which has now been proven, and the Navy submitted it.
Oh yeah.
That came, and my wife and I had to decide, if I take this route due to the strict nature of our community's career, progression and timelines, if I miss a tour, if I miss even, a 6-month window, you can pretty much count your career as over as far as progressing. Now, there's a lot of scabs that hang around the military for 20 years. Like I could just limp along and get to 20 doing something, but my career as a helicopter pilot was essentially over. I got back to San Diego, where I currently live, and I checked in to start my 3-year tour. I signed a 3-year contract extension in exchange for a bonus, because that's when everyone can either get out, and that's where most pilots jump ship and go to the airlines. So I signed a contract. I took the bonus to stay in for 3 years and promptly got benched as soon as I got back here to San Diego. And by benched, I mean I wasn't allowed to fly. I wasn't allowed to proceed on orders from my squadron. I couldn't do anything. That lasted for 2 years. And at the 2-year mark, I was bounced around to various TDYs and just different pointless assignments. And at the 2-year mark, they said, all right, mandate's over. You can go back to flying. You need to restart your 3-year counter. I said, that's not how a contract works. The contract that you wrote and that I signed expires in June of 2024. So if you want to offer me an extension, you can, but I'm going to hold you to the contract that's in force. And they said, well, if you do that, we're going to charge you with breach of contract and take back the money, and we're going to send you to some kind of tour to fill the last year. Jeez. I said, like, here are the tenets of contract law that apply here. I had my legal team. There's some great lawyers that are basically been working for us pro bono. They sent all the documentation needed to make a conclusive case. But the thing with the military, the thing with the government, and hopefully we're seeing some progress of these things being undone at the federal level, but they just don't respond. You can, I went down the rabbit hole of sending notice and affidavit and all that stuff that we have been learning collectively. I as a group of people that have been awake in the last couple of years to what's going on, a lot of people have kind of dove into the common law, cease and desist, notice of affidavit, all that stuff, right? But the military just ignores it, and no one holds them accountable. So we did all administrative avenues, and they just ignore it. Like, you can send them a notice, you can send them an affidavit, whatever. If they don't respond and just never do anything with it, like, it's hard to get someone to go to bat for you to fight the U.S. government. Fortunately, that's all kind of collapsing now, but I am past all of that.
Yeah.
It's been a pretty long battle where this might be the first time I've ever talked about it without getting really heated and just angry, because even though I'm glad to be done with it, I feel like I was given a life raft off the Titanic. I want no part of what the military is involved in right now, or what they seem to be keyed up to get involved in.
Yep.
I'm so grateful that I never have to leave my daughters on a deployment. I wouldn't trade any of it, but still just the unjustness of it, the fact that
Yeah.
I could be legally vindicated, medically vindicated, and administratively vindicated on all fronts. And still the Navy is just like, oh, well, whatever, we'll still take your money back. So I'm in debt to the
Yep.
Treasury now. They took back my bonus, sent it to debt collections.
Wow.
It's been very eye-opening, but I wouldn't trade any of it. And I consider pretty substantial debt that they put me in. I consider it kind of my exit ticket. You know, I had to pay a price to
Yeah.
get out. And during that 2-year period where I was benched from flying, I said, I have to make something of this time. You know, it's not too bad. I'm getting paid as a stay-at-home dad. I'm full time with my daughters. All my friends are all out on deployments, missing their kids growing up. So even that was a blessing. But I was like, I wanted to get something out of this. I don't want to just sit here, pass the time, and see what happens. And so I decided to dive into the financial world. And
Okay.
I had been my master's program was at Harvard Kennedy School, and I took a lot of economics classes. I got to ask questions of Janet Yellen and
Yeah. I
Jason
remember
Furman.
that in your letter, dude. That's so hilarious.
Yeah, so like Jason Furman was
Oh,
Obama's economic advisor. I had outside of the academic economist world, people don't really recognize a lot of these names, but Larry Summers is one that people probably recognize. I got to ask them these questions that a lot of us, from whether it's reading Creature from Jekyll Island, learning about the fractional reserve system, all of these economic rabbit trails, right? I got to ask them questions in real time as I'm learning this stuff and realizing that there is nobody at the wheel here. This train, the answer that they all gave me was this printing of money, et cetera, can continue as long as people are willing to buy our debt. And that just didn't really sit right with me. And
wow.
so I kind of had this approach to finance the same way I had to kind of rethink everything I thought I'd ever assumed about the military, the medical system, the government, et cetera. And the approach, the analogy that really tied things in was when any of us went to a medical provider, not that many of us did, but if you went to a medical provider in the 2020, 2021 time period, without evaluating you as an individual, your personal, like your physical makeup, your health history, any medical conditions, without any specific knowledge of you, they still recommended a COVID shot, right?
Yep.
And that was blanket advice. And in the same way, in the financial world, we are all given the same advice. If you go to a CFP, you're going to get the same advice. You're going to be told high risk equals high rewards, time in the market, not timing the market. You're in it for the long run, set it and forget it, average rate of return. You're going to be told all these things. You're going to be told the same order of operations. It's going to be max after qualified retirement accounts, save up an emergency fund. And then once you have that, then invest in a brokerage fund and mutual funds, right? I have worked with a lot of clients now, and I will get into specifically how we approach finance and what infinite banking is. But I've never come across two clients with the same situation. I've never given the same advice to the same two clients, because we have to we kind of do like a financial surgery and almost look at the whole picture, get everything out on the playing table, and actually look at all these. You know, everyone has what you call a financial junk drawer, right? Over the course of your last 10, 15 years, you
Yep.
have different products, different investment vehicles, different financial vehicles from different people that suited your best knowledge at the time of where you were and what you needed or thought you needed at the time. So you might have these 15 different places where your money is currently residing, but have those advisors coordinated with each other? Have they ever talked to each other? Is there any cohesive strategy here? And we mostly find that's not the case. And what we're all getting is the average advice. And if you look around, if you just think of your network and people, financially average means people can't come up with $400 for an emergency. It means the average 401k balance for retirees right now is about 260,000, I think was the last Fidelity study. The average balance across the entire spectrum of people with 401ks is like 120,000. Right. So a car right now, my wife and I are in the market for a bigger car. It's like $60,000 if you want just some of the basic requirements you have, right? So does 120,000, even if you're retired, does 260,000, is that going to get you for an unknown amount of life? No.
No.
that's kind of the approach I took going into this, and realizing that the way that the medical community was giving us all the exact same advice, regardless of our individual conditions, we were all getting the same financial advice without much regard for individual conditions. It's like you might evaluate a few things about my situation, but the ultimate advice is always the same: max out your retirement plan and then save in mutual funds, right? And so my partner and I, he was an Air Force pilot also in the mandate fight. That's how we met. We connected, and our clients are in large part military pilots, because people who have been through this fight with the government on the medical side, on the military side, and realizing we've been tricked in these aspects are fairly open to exploring maybe we've been tricked elsewhere. I know I've just said a lot there. So
No, that's great, man. I mean, that's such a key point to focus in on. And it's like the financial system is really designed for people to not understand the first thing about it.
yeah,
To not have
you need an expert.
any concept or understanding about it whatsoever. It's like, I would say my financial literacy is probably bottom level. Like, I don't know much about, I know, okay. So I do know that Creature from Jekyll Island, I've read like half of it. I know about fractional reserve banking. I know how money is printed, where it comes from, but then it kind of gets ambiguous from that point on. It's like,
What do you do with that
treasury,
knowledge?
I don't know. Yeah, exactly. I don't know what to do with that. It's like, so I don't want to get too much into my own personal stuff, but it's like, all I'm just saying is that, like, I feel like there's opportunities for, if I'm in a situation where I feel like there's opportunities, I'm sure most people out there do as well. You know what I mean? And it's like, so just, but the idea of, and from what little I do know about infinite banking from the research going into this episode, it's, I hear you saying, be your own banker, like take back, your own like sovereignty almost in a way, because we know these banks, anybody that knows, well, why don't I just kick it to you? These banks operate under the principle of fractional reserve banking, and they're the ones that are benefiting from our deposits going into their banks, right? So can you explain, just, I know it's a very complicated topic, but anybody that may be listening that doesn't quite understand that concept, maybe just a cursory just description of like how the banks are taking advantage of us, or how they are the ones that win at our expense.
Yeah. Now let's, so before we even broach infinite banking, we need to identify the problem.
Sure.
You did a good job of vocalizing the problem, which is that even if you've gone through and kind of read the Creature from Jekyll Island, learned about the fraud that's happened, what do you do with that? Okay, that's good to know, but you still need to provide income. You still have, you need to live and provide for yourself, and you need to optimize. So the approach that we take, Brian, my partner, and I are both big on the preparedness angle. We're big on the parallel economy, hard assets, etc. But the way that we frame it is that we have to operate in this fiat world, right? We don't get to say, I have gold and silver, I want gold and silver, but like I'm going to be paid in dollars, I believe, for the rest of my life. And everything I want to get, even the assets I want to acquire on the prepping side, including gold, silver, property, like raw land, whether it's a homestead, chickens, I have to transact in dollars, right? For the large part. And so as long as we are in this system, how do we optimize it? That's the approach we take. So we don't just go right to sell every dollar because the dollar's worthless and just buy gold. It's like, well, then when I die, I'm going to leave my daughters a safe full of gold that they're then going to have to go convert back to dollars to do anything with, right? And so we want to optimize within the fiat system. And so how do you do that? But we need to identify, what do banks want? What do financial institutions want? They want four things. They want our money. They want it on a regular and a recurring basis. They want to hold it for as long as possible. And they want, when it comes time to distribute it to us, they want to distribute as little as possible. So what did I just describe? I just described a qualified plan. We provide the income. We do it on a recurring basis now because you have to opt out of it with your employer. They sit on it for 3-4 decades, cash flowing it the whole time. While we value this future payout of net worth, we essentially, we go earn, shovel aside, and then we flip a switch, we stop working, and now whatever this is what we have to live on. That's the strategy that you're going to be presented by the CFP. You need to build this mountain of money high enough so that it can sustain you for an indefinite amount of time. Well, we're in a fiat system. If you had told your parents, my parents, that we'd be looking at cars that are $60,000 to $70,000, they'd be like, "What are you talking about? We paid our house." Yeah. I was born in 1988. houses now where I live, I mean, everything's over $1 million. There's nothing under $1 million, right? And that's the case in every city in the country. And so
Yep.
how do you think you can possibly come up with a number of here's how much I need to live X number of years into the future, and then that is going to last me people that made that plan when I was born, 1988. If someone sat down with their CFP and made that plan and said, "Hey, I'd like to continue my life at $100,000. I want to build up to where I have $100,000 of income a year." Maybe they're there now at their retirement age. Is that enough? 100,000? Maybe, but probably not, right? And so we want to remove that uncertainty. So they want our money, and why do they want it? They want it because that fractional reserve system we talked about, that is the basis for their loans. And so when you talk about fractional reserves, the example we always cite is 10%. So of the total amount of money, and keeping it very simple, like if we each have $1,000 in the checking account, right? They don't need to have $2,000 in the checking account. They just need to have 10% of that. If you have a 10% fractional reserve, technically since COVID, it's been zero.
Yeah.
So there's technically infinite money, but that is kind of what the fractional reserve system is. That's why they want our money. So if I deposit my money in a savings account and I'm getting 4% interest, and I put $1,000 in there, they can loan that out 9 more times because I have one claim to 1,000, but 9 more people can have a claim to that 1,000. But that 1,000 looks like a loan to you, a loan to whoever else, right? So I'm keeping a very surface level here, and it doesn't happen immediately. It's not like they get 1,000, they loan out 900 right away. It's phased. There's a great book called How Privatized Banking Really Works. That will walk you through step by step how this actual fractional reserve system, how it plays out. It's a slow build where you get this mountain of claims on a small pool of dollars. That's why you have a bank run. So they want our money. They want it as long as possible, because what are they doing in the meantime? The 30 years that I'm just watching my nest egg grow and doing nothing with it, they're cash flowing it. They're loaning that out to 9 other people, every one of those dollars.
Yeah. And then this is how that gets so crazy and out of control. Like this is like, so they talk about once it went to 0% reserves around like the 2020 mark, then they just went off the deep end. And like, I mean, I've heard this stat a million times that 80% of the money in existence was printed since 2020. Like, look at this. It's just like, this is this lower line right here. Oh yeah, you can see my mouse. So this is all the money in existence, you guys, like to 2018, 2019, all the money that's ever been printed in existence is represented by this little graph right here. And all of a sudden, this is where we're at today. This is where you're seeing the inflation. Like, it's just madness. Like, this is how they have been able to use this fractional reserve system to just rape everybody, dude.
Yeah, and the interesting thing we see is that people are the biggest, it's like Stockholm syndrome, they're the biggest offenders of their captors. So imagine if you own a company in the 60s and every employee that hit whatever your criteria was for a pension, 20, 25 years, whatever, you now are on the hook for their health insurance, a pension salary for the rest of their life, right?
Yep.
So you provide the capital, and what happens when the market goes down? You're still on the hook for the capital. So all of a sudden we have this 401k come along, qualified plan. Not only are the companies relieved of the obligation to provide the capital, because now we are funding our own retirements, but they're also relieved of the market risk. Because what happens if your 401k takes a 50% hit like it did in 08, or a 30% hit like it did? You're going to call someone and say, hey, where's my 401k balance? They say, hey, the market goes up, the market goes down, but that's the risk, right? So we have assumed the obligation to provide the capital, and we've assumed the market risk. And the biggest challenge we get from people when we talk about this, I haven't even gotten into what infinite banking is, is people comparing it to the 401k. Hey, I could do better. Why would I do this when I could do better and make more money in the market? And we have to differentiate between two concepts here: cash flow versus net worth. Cash flow pays the bills. Net worth does not pay the bills. Net worth is a future value. It's good to have. It's good to measure and track, but it doesn't address uncertainty. Because what if a house is, what if a car costs what a house does by that point, right? And so when we're talking about this, that we focus on cash flow. We want to. I would rather have a target number of monthly income, passive income. We try to build cash flowing assets that support our lives now, because I don't want to just postpone the life we want to live until I retire. Because you do that accumulation model, people can't just flip a switch and all of a sudden, just now you're living on less and you're just going to do nothing all day. Like, why this idea that you go to the CFP and here's how much you're living on now, but when you're older, you won't have a mortgage, you're not going to have kids in the house. So 70% is what they always say. They say we're just going to live on 70%, right? If you've had conversations with a financial planner, that's what they're always going to say. Why would your life get cheaper when every day is a Saturday?
Yeah.
Right?
Yeah.
Now, if you think of how long the average retirement is, how much time do people spend planning for, budgeting for, thinking through all the details of a 1-week vacation?
Yeah.
Think about your family vacation. You're excited for, you're looking forward to, you do a lot of planning. That's more than most people actually plan for their retirement, which is hundreds of weeks of vacation, right? And so
Yeah.
it's this strategy without any certainty.
Yeah.
And then and the other thing comes down to liquidity versus leverage. And so I'm sorry, let me liquidate or leverage. Those are the two things you can do with your capital to enjoy it as income. Because again, we want cash flow when it comes time to retire. If we do that, now I don't believe in retirement. I don't plan to retire. I plan to subsidize my cost of living through passive income, but I don't plan to just sit around. But even if we just go like we'll keep it on their terms, we'll assume we're trying to retire. Now you have this mountain of money. You can either do two things with it to get the income that you actually need today. You can liquidate it or you can leverage it. One of those options extinguishes your principal and one of them keeps it intact.
Yeah.
Right. So if you have a 401k, you still have to withdraw. You have to liquidate those equities, convert them to a money market account, transfer that to your account. And now that money's done working for you forever. It's never going to earn for you again. Versus leverage. If you have an asset that you can access and you can borrow against without liquidating the principal, so it compounds uninterrupted, that's another strategy. Of the two, if you can have either one of them, which would you rather have? I would rather have the ability to leverage and put that money to work in more than one place. And that starts to kind of get into what we're talking about in infinite banking.
Let's do it. Yeah, man, because retiring is very gay. Anybody that's retired is just you're gonna have to pay that away, guys. So I love it, man.
I'll give the boomer generation a pass because it was, I mean, that's been the conventional wisdom for decades now, right? And I think we're hearing a lot of people challenge that now. I think that idea is kind of getting less popular, at least in the spheres I'm in. I don't know many people who want to retire in that sense of the word, but what we want to do is we want to live that life now, not just in 30 years.
Exactly, dude. I'm 100% there. And it really is all about developing multiple sources of income, passive income. I'm working on setting something up right now that I'm hoping it's just like set it and forget it type of thing. That's going to really be a cool deal, and just like having the entrepreneurial mindset. That's one of the biggest gifts I was given out of getting out of the paycheck mentality, being relieved from that office job, like going off on my own. I started my own handyman business, like all these other various projects I'm involved in. It just gives me complete freedom and autonomy. And I feel just almost grateful that I've landed in this position in life. And so once you get into that entrepreneurial mindset, you're like, okay, I'm at the point now. It's like, okay, how can I make my money work for me now? So that's why I'm so curious to get into this stuff. So tell us about infinite banking. Do you feel like that gives us enough of a basis to unpack it here?
I think it does. And
okay,
and I don't want to, I could talk from this for 50 hours.
I feel you.
But we have a podcast, Remnant Finance Podcast. It's on all the players. And
there's a link in the episode description, you guys. So there's a link below. So if you click the link in the episode description, it'll take you to the YouTube channel, Apple, and Spotify. So go check out his show. I've been listening to episodes in preparation for this. Great stuff. They're doing amazing work. So please go follow, subscribe, and support all the work they're doing with the podcast.
Yeah, and our goal with that is to talk, obviously about finance, obviously about infinite banking, but we also want to address the relevant cultural things. We want to talk about things that impact our finances without a filter. And so I don't know how much longer, we don't have very long shelf life on YouTube, I don't think. But we don't filter ourselves in these conversations because people don't want a filter. Like, people want actual discussion. So when we talk about this, our approach to this is protect, save, grow. Vice the typical mindset, which is grow, 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 grow. Everyone we talk to that challenges this idea, which is natural. We all have challenges because this is a new concept for most people. We are never taught this way of thinking at all. It's always, like I said, why would I do this, put money in here when I can invest it and make more? It's because you're comparing a savings vehicle to an investment. I am not telling you how to grow your money in an investment here. I am telling you the optimal place to save and protect your capital and protect your family. What good is a huge nest egg if your home is in Pacific Palisades and you
Yep.
just got it just washed away or just burned down and you had no insurance on that house? The value of insurance, there's many facets to this, but what infinite banking is a process. It's just the understanding of the banking function and the flow and control of capital. What do bankers do? Do bankers set it and forget it? No. They're very minute with their control of capital. Are they in it for the long run? No. High risk equals high. Like when I take out a mortgage, I'm closing on a rental property right now. Do you think they're looking at this and they're going to give me this, maybe if I was a risky borrower, would they be like, oh, this borrower has bad credit and not many assets, high risk, high reward. We're going to get, no, of course not. You have to over collateralize. If they're going to loan you 100,000, they're going to make sure that under any possible outcome, they can get 110 back, right?
Yeah.
They're not going to enter into a deal with you if they don't have 100% or more collateral, right? So they don't believe high risk equals high return. What is risk? Risk is the probability of loss. So what we're telling young people is high risk equals high reward. High probability of loss equals higher reward, maybe. But it's just this idea that the best thing you can do with your money is just leave it with us to manage and grow. And with that, during that time, they're banking it. So we want to protect our family. We want to capture something that's called human life value. You, Scott, if we listed all your assets right now, maybe you have you just got a truck you paid for in cash, right?
Yep.
You got a paid off truck. I don't know what your housing situation is. You might have a paid off home. Maybe you have $200,000 of equity in your home. Maybe you have gold in your safe, and maybe you have, a retirement account. You list all these assets, right? Well, the one asset that people never talk about, your most valuable asset, is the fact that you show up every day and your labor provides value for you and your family.
Show up every day and crush, folks. That's how.
Yeah, exactly. You're crushing. So if you're making $100,000 a year, your most valuable asset is the fact that you, as a working man or woman, can provide 6 figures of income to your family, right? That's your most valuable asset. Insurance is not making anyone rich. It's a replacement cost. That's why we get all these tax benefits. And we'll talk about that in a minute. It's because, like, if I go and total my car, I don't want to have outlived a term policy for my car, right? I don't want a 3-year auto insurance. Then I wreck it in year 4 and now I have no coverage. I want to be made whole if I totaled my car.
By the way, you guys, full coverage, baby. I'm a big fan of full coverage. I've always carried full coverage. And I wrecked my truck in an ice storm a couple months ago. And dude, if I didn't have full coverage, I'd be so screwed. But I was able to, like, basically between that and the little savings I had, I was able to buy a nice new truck, paid off in full. Well, I put a little bit on a credit card, but I'm almost paid off with that. But still, like, essentially, like, I didn't have to take out a loan, is what I'm saying. Like, that's the big thing. I didn't have to dip into that. But maybe that's the mentality I had going into this. But it sounds like I'm completely wrong on that.
Well, where you're at,
infinite banking mentality.
Yeah. I mean, what you have right now is the sum of the best advice you've gotten so far, right?
Yeah. So I'm really curious to learn. And it was so funny because, like, literally the example you used in that video was the exact situation down to the dollar amount that I was in before. So it's so funny. Yeah. I was like, whoa, dude. Okay. So now I'm like, now you got my attention. Yeah.
Yeah. And I came around to this idea by trying to poke holes in it. Yeah. When I first got Nelson Nash's book, Becoming Your Own Banker, I tore it apart and tried to show I know better. I've been a student of personal finance and macroeconomics, in an unofficial capacity for my entire adult life. There's no way life insurance is a bad place to put your money. And I realized by trying to poke holes in it, it just stands up, And so if I have insurance on my car, and I have insurance on my house for full replacement value, I don't know that my house is going to burn down. I don't know that I've never totaled a car in my life, but 100% of the days that I've had a car, I've had 100% replacement insurance. I've never totaled my car. But then when I sell the car or I get rid of it, I cancel that coverage, right? And now it was just an expense. I didn't get anything from it. I had the peace of mind there. But what are we doing with ourselves? If you, Scott, can make $100,000 a year, I'm going to make up a client here, 35-year-old who makes 100,000 a year. What the insurance company is going to say is, you as an asset, as an income producing asset, are worth $3 million. How do we get that? You have 30 more working years left till average age of retirement at 65. And we're going to take a snapshot in time of your income. So if you die today, your wife, your children, what they are missing out on is the rest of your working life. The income that you are expected to provide for your family is measured as a snapshot of your income today times the working years you have left. Now there's more, it's more complicated than that. Got some textbooks behind me where you can really get into how that's calculated, but for our purposes today, that's your rough calculation. So take your income, multiply by how many years you have till 65. You as an asset are worth that much. And so what happens if I die right now with no insurance, or, a $500,000 term policy? My wife gets shortchanged, right? It's like if you had on your $30,000 truck, if you had $10,000 of insurance, well, that's something, but you're still not made whole, right?
Mm-hmm.
But if we think of it in the car or the auto or the car or the home analogy, it's like your life is a car that 100% will be totaled. If your working career, your ability to earn income is a house, it will burn down. 100%. I don't know much about you. I listen to your podcast for a while. I know some about you, but I know the car that is your life will burn down. The house, will crash. So total. The house that is your life will burn down. I'm kind of mixing analogies here, but if we know that with certainty, then we can plan to replace our income for our family, and that's called your human life value. That's what we want to protect. So what good, on this protection idea, we want to make sure that if we walk off this earth today, those who depend on us, our income doesn't walk off with them. If I die today, my wife is going to get about $5 million tax-free. That sounds like a lot of money, but she's not being made rich from that. She's just being made whole, because that is what the company says I will provide by the time I'm 65 to my family. She's just being made whole. When you got that check from the insurance company, that wasn't taxable, was it? No, because that's not income.
Yep, nope. Yep, correct.
It's not. You didn't get income. You just got replaced whole. You just got back to even.
Yep.
Same thing with this. Death benefit on an insurance policy is tax-free because it's not income. It's just making you whole. You cannot be overinsured. Your life can't be overinsured, but most of Americans are chronically underinsured. Also on the protection piece, and again, but this is all before we get to growth. So like this whole conversation is before we ever mention how to grow your money in an investment. These are the things we have to get in place first. We talk about protection. If I have a $5 million nest egg, I'm 65. I just outlived my term policy. I got $5 million in my retirement accounts and my brokerage accounts, and I've got a paid off house. I've got $5 million net worth. That's great. Well, I sit down with a client. We lay out all their assets on a piece of paper. And I say, all right, let's just play a little game here. We listed everything on here. You just get a call while we're in this meeting. Your wife got in a car accident, hit someone. She was just determined to be at fault, and you have a $1.5 million lawsuit against you. Happens every single day in America. Circle which of these assets would survive that lawsuit intact. Most people, because we don't get taught this, could not even tell you which of their assets are protected from a liability claim. If they do know that, most of the time people realize I wouldn't survive this. I mean, I physically survive, but like this is wiping out this plan. So if you're that retired couple, you got the 30-year term, you bought term and invested the difference in your 30s, you just outlived the term, you have a $5 million nest egg, and you're living in Pacific Palisades, your house just burned down with no replacement coverage. You might have considered yourself, had you listened to financial entertainers, you might have considered yourself self-insured. They say, yeah, you want to have this term policy while you're working just as a backup. But once you get to the retirement age, you build up this mountain of capital, you're going to live off that and you'll be able to self-insure. Well, that's a myth, because now if 3 million of my 5 million was my house and that just burned down, I'm at 2 million. I don't get back up to 5. I can liquidate those assets and rebuild my house, but that's all I can do. Right. So when we are talking about whole life insurance, we are talking about matching a guaranteed event, i.e. you will die, with a guaranteed outcome, i.e. a tax-free estate to make your family whole when you pass. And because this payment is guaranteed contractually, we're backing our financial strategy on contract law, not market speculation. Because it's guaranteed, it has a net present value today. And that is the piece, the first mention of infinite banking here, that is the piece that we use that we can leverage and take advantage of the contractual rights in the policy while we're living today.
Okay. Yeah. So this is where the gap that we need to bridge here was like
Yep.
basically you do I want to refer back to, let me see if I can pull this episode up. But anyway, if you guys go to their YouTube channel, follow the link below, one of the very first episodes. It's what's the name of it? It's Infinite Banking Explained, I think. Something like that. And it's basically you lay out all of the problem, kind of like we're doing here, but then you're saying like, so we have this money, this cash or whatever. It's like we need to park it somewhere.
Yep.
Instead of taking it to the bank, when let the bank profit and make money off of it, we can use it ourselves. So that was the piece that kind of clicked for me, is like, so let's start there. Like, let's say I have money, I have cash, or let's say I want to take money out of my bank account, and where would I park it? What does that look like? How does that work?
Yeah. So, man, there's a lot of ways there's just so much that like people just need to know. And again, our podcast, our blog, we cover a lot of this stuff in detail, and I am happy to just take a call and chat with you through this. You do not have to, like, anyone who works with us never pays us. Like the way that insurance is, like you get paid by the company if a policy goes in force, but no one ever pays us. So like you can schedule with me. I will sit and talk to you. We can talk through stuff and you can never talk to me again. Like no big deal. That, like, we want this education out there. I want to make one more point before we go into
Okay, sure.
IBC.
Of course.
And the example that you had, which was you replace your truck, right?
Mm-hmm.
So I do a blog article. It's called "You Finance Everything You Buy." That is a quip from Nelson Nash, who wrote "Becoming Your Own Banker." You finance everything you buy. You either pay interest to someone else or you give up the earning power of the cash that you're giving away. So if we imagine, so you crash your truck, you total it, you get a check from insurance, you withdraw some savings, and now you have $30,000 in cash, which you said you used to purchase your truck, right?
Mm-hmm.
Now, let's just say this mouse right here is a $30,000 mouse, but instead of being a stack of $30,000, it's a little printer. And the printer right now is dialed to 4%. So whoever holds this mouse, it costs me, it's a $30,000 value, but the real value of it is what you can do with it. So I dial in 4%. That's the current roughly, high yield savings account. Whoever has this mouse can at a minimum right now make 4% per year, right? So what you do if you walk into the dealership and you have the cash versus, say you go in with cash, I go in with, and I finance with the dealer and I take their terms. They give me a loan. I pay a 5-year loan and I borrow 30,000. I pay back 36 over the course of 5 years. You bring in $30,000 cash. You don't finance it. You walk out with a car, but no cash. I still have my 30,000. I didn't give this up. I have a debt to them. We both financed it because what you did was you handed them this little money printer and you said, here, you give me a car and I'm going to give you this little money printer. So now they have the use and enjoyment of that $30,000 that is never coming back into your life again. Right. And so that's kind of an example, a simple example, but that's how it's like you finance everything you buy.
Bastards took my money printer, dude.
Yeah. And so if this is your money printer, like I want to hold on, is there a way that I can hold on to this and still get the car and still get these things without giving up? Now, again, of course I can do that with the dealership, but what if I could take over the terms of the loan?
Yeah.
What if I become my own banker? And what if I give back to my system instead of their system? They're just doing the same thing.
Now we're talking.
Yes. Yeah. What do banks do? And so that's what we want to do. So with a whole life policy, we have a death benefit, which is a guaranteed future payment, and cash value, which is the current net present value of a future payout. Right. I'll run through one more simple example here. Instead of $30,000, we're just going to call this a little bond, a little note for $1,000. This little mouse, whoever holds this mouse 1 year from today, February 6, 2026, will get $1,000, right? So I'm holding on to this right now, and I plan to wait a year, sit on it and cash it, and I'm going to get $1,000. However I acquired it, I have it now. This thing is payable for $1,000 in 1 year. Well, if I want to sell this and I said, hey, Scott, do you want to buy this? If you buy this from me, then in 1 year, you'll get $10,000. It's only $1,000. Would you take that? Would you buy that?
100%.
Well, then we need to have a more conversation here, because would you pay $1,000 today out of your pocket? Like, remember, you're giving me cash that I'm going to use now. You're going to delay getting $1,000. What I'm trying to say is that you should not pay me the value now that you will have to wait a year to get.
Oh,
You see what I'm saying?
Interesting. See, to me, that's a great investment. I was like, this sounds like some meme coin or something. I'm like, that sounds amazing.
No, that's a
Man.
1-for-1 exchange. I'm saying
Okay.
you give me $1,000 today, I'll give you $1,000 in a year.
Oh, I see. Oh, I thought you said 10,000 in a year.
No, sorry, 1,000. I'm sorry.
Okay.
I'm sorry.
Okay. Yeah. I see. If
Right.
you, I thought you said I'll give you $1,000 today for that little mouse, and then a year it'll be worth 10,000. I was like, hell yeah, let's do it.
No, okay,
Anyway.
yeah,
Okay.
sorry.
Okay.
Then you did read that correctly.
Yeah.
But let's just say whatever the amount is, say the amount.
Okay. Yeah.
A
So
thousand
I give it to
bucks.
you today, and it's worth the exact same a year from now. But no, because then inflation's happened and all this other
Right.
nonsense,
And
and
you can't make any money
Ukraine,
within the
and
meantime.
yeah, and
Because I'm gonna take
Israel's
that
taking
thousand
over the
dollars and
whole
at
Middle
least make
East.
four.
Yeah.
I'll at
Yeah.
least make 4%. You won't.
Yeah.
But maybe it's worth 900 to you.
Sure.
Maybe. You say, hey, I'll give
Maybe.
up 900 today to guarantee I make about 11% return in a year. What the point is, you have a number.
Yeah.
It's not 1,000.
Yeah.
I wouldn't take $100 for it, right? Because I would
Sure.
rather just instead of, so, but there is a market price for what this is worth today. That's the net present value.
Mm-hmm.
So if I said you have to wait 2 years now, would you still pay 900? No,
No.
because it was worth it to you to get $100 return by waiting a year, but it's not going to be worth it for the same return with double the time frame. Like just very basic. If there's a guaranteed payout in the future, there is a net present value today.
Yeah.
So what if I said, hey, you can have this for $900, but it also comes with a requirement to pay an extra $10 a month in order to keep it for this thing to pay out. So now you're incurring an extra charge, right? So that's going to lower the value as well, right? So we take that analogy. We have the tax-free death benefit is a future payout to your beneficiaries down the road, but it's worth today from now until it's actually paid out. It's worth something today. That's the cash value. Sorry for making that more confusing.
That's all right. That's
but
right. No, we got it.
so that cash value is something that we have contractual rights to access without liquidating. And that it kind of gets into a little bit more of the underwriting side of things. But if I put my money into this whole life policy, I am building cash value. The way that we structure, and this is going to be maybe a little more next level, but there's two types of premium. One of them builds cash value instantly. The other one builds cash value over time. End of the day, I put in $50,000 a year into my whole life policy, like my actual numbers. 35,000 of that is the type of premium that's available as cash value right away. The other 15 puts in force this large death benefit. Now I'm gonna breeze over a lot of details here.
Okay.
But what we're doing is we're overfunding early and building up that cash value aggressively now. Now I have a pool of capital that I can borrow against. So my current policy is $1 million whole life policy. I took out a $30,000 loan to buy a rental property, which is now cash flowing for me. I borrowed from the insurance companies from their account, and they gave me a loan from their money, not from my money. My cash value, in this case, 35,000. My cash value was untouched. So that amount is growing guaranteed. It's compounding guaranteed without any interruption because it's not market based. It's contractual guaranteed. I'm also getting dividends. We use a mutual company. Therefore, the policyholders get the dividends, which are tax free. The dividends get paid to the policyholders. And so I am growing this as if I never touched it, my cash value.
Mm.
I'm not liquidating it. I'm keeping it intact to grow in full. And I have this separate loan from the company. But it's the best lending terms that you could possibly have. And the reason is because I borrowed $30,000 from the company. I die the next day with that loan outstanding. They're going to say to my wife, hey, we owe you $1 million. But Hans essentially asked for an advance. We paid him 30 and he didn't repay the loan. So we're going to make ourselves whole from the death benefit and you would get 970. That's because the lender, this is the only situation in the whole world of financing where the lender is also the guarantor of the collateral. They know exactly how much it's worth. The bank doesn't know exactly how much the house is worth or what it's going to be worth if they have to evict you or whatever, foreclose on you, right? They don't know exactly how much it's worth, so they have to estimate. In this case, they have my cash value. They know exactly how much it's worth because it's a contract. It's not market based. So they know exactly the value of the collateral, so they can loan against it and there's no default risk. Because there's no default risk, there's no schedule on the payment. I control the terms. The only term they give me is what the current interest rate is, but I control the repayment. If I opt to not pay it, I don't have to. We want to teach our clients to be good bankers and replenish your capital. So we don't just advise like take out a loan and never pay it back. But the power of this is you don't have to pay it back, because the company says, if you think of what is an interest rate is a combination of the time value of money and default risk. Right. So if you have two people and one of them has perfect credit, a lot of assets, and the other one is a college student who wants money to buy video games, if you loan them both money, the time value of money is the same. If I loan them each $10,000 for 2 years, whatever, the time value of money that I'm losing is the same on both of them, but the default risk is very different, right?
Mm-hmm.
That's going to determine our relative interest rates there. But if you remove the default risk, as in the company says, hey, we're going to loan you money. If you don't pay us back, we're not going to tell you when to pay us back. You don't get a note saying you have to pay this much back. Here's how much is owed this month, this year, whatever. You're never going to hear from them. That is a loan. It's going to grow at the interest rate. But if you don't pay us back, we will get paid back from the death benefit, because essentially you just asked for an advance of it. That is kind of in a nutshell the power of the policy loan component of this. I have an article on our blog. We have a podcast episode. If you really want to get into the specifics of stuff, our policy or our episodes about policy mechanics like this are called Under the Hood. So we have one on policy loans, on, like all these facets of like what is cash value, et cetera. But that ability, so I invested in a real estate rental property that is currently cash flowing. So I'm collecting the interest on that rental property, but I left my cash value intact to grow uninterrupted. Had I just taken that same amount of money and put it into a rental property, that's a great move. It could be a great move for me, but I just have I've moved that money out of my life forever. And now I have the rental property, which is generating income.
Mm-hmm.
But if I die the next day, like that's when I'm leaving my wife as the rental property with a mortgage on it. Because in my case, I didn't fund the entire property with a policy loan where I control the note. I did what I could towards it. That's how we can buy our debt down. So what I would do when we're in the process of buying a car is I have three options here. I could save up cash. We'll go with 60,000 now, because we need like a SUV with extra seats and stuff. And so we'll say 60,000. So I could save up that money and hand it over to them. And I give them this cash flow mouse. They get my little money printer, and I will have an SUV. I could hold on to this because I know I could do more with it and borrow from them. And maybe they charge me 6%, which they're turning right around from someone who's depositing, and someone's getting a 3% rate of return on their savings, and they're loaning to me at 6%. That's 100% return on their part, right? That is the power of banking. You're loaning out other people's money and making hundreds of percent return. So I could do that. I could say, hey, I'd rather keep this money myself. I'm a good steward of it. I can invest it and I can earn more than I'm going to pay to the car dealership. I can do that. But what I can also do, I can borrow from my policy. I say to the company, I want a policy loan for $60,000. There's no underwriting. There's no questions asked, because it's contractual right. Again, this all comes down to contract law. This is a contract, not a market speculation, not a prospectus. They say, all right, how much do you want and what account do you want it in? A couple of days later, I have the money in my account. So I'm also, when I'm walking into this dealership next month or whenever it happens, I'm also going to walk in with a stack of cash. It's the insurance company's cash. They've essentially put a lien on my cash value, as in if I don't pay this back, it'll come out of the death benefit one day, but I don't have to pay it back. It's on my terms when I choose to. So I did give them the $60,000, but I did not touch the money that I put into my policy, right? Because that was uninterrupted. And again, on our blog, I have an article, how to use a policy loan, and I visualize the movement of money. I kind of try to draw it out and walk through it for visual learners, what we're actually doing here, how these moves actually look. But I will now have a loan. I'll have a policy loan to the company. I'll have my entire principal and my cash value growing uninterrupted, earning dividends. I'll have the rental property or the car or whatever it is. And I do have a loan. Like, this isn't free money. This isn't like a magic. Sure. This isn't magic. You finance everything you buy. All three of us, I'm looking at myself and you and the screen.
Sure.
So I'm thinking there's three of us, but the person who uses IBC, the person who borrows from the dealership, and the person who pays cash, we're all financing. You can't get around that. Yeah. You're going to either pay someone else interest, or you're going to give up the interest your money could earn. Now think about this. My daughter wants a car. In 15 years, she turns 18. She wants a car. She has these same options. But what am I going to do? I'm going to say, hey, instead of going to the dealership and paying them, what you're going to do is you're going to borrow from the bank of dad. Yeah. Here is your money. You're going to take this 30,000 and you're going to walk in and buy a car in cash. But I now have a loan against my cash value. I'm going to teach her financial responsibility, the control of the financial physics. Like she's going to be an honest banker herself. She's going to pay me back with interest, right? But what's she doing every time now there's a misconception that people say when you pay yourself back, you're putting the interest in your policy. You're not. This is a loan to the insurance company. The interest goes to them. But
How much is so there is interest though from the insurance, right?
yeah. This
Yeah,
is
yeah.
this is an investment for them.
Yeah.
And it's the safest investment they have because they can't be defaulted on. They can't lose. But yeah, it's an investment for them. When I pay them back, I contribute to their profitability. I'm an owner of the company because we only use mutual companies. I get the dividends.
Okay.
But what happens when my daughter pays me back and I'm repaying this loan to the insurance company? What she's doing is just replenishing the bucket that I dipped into of that future $1 million death benefit. I'm making that $30,000 could walk out the door forever and go to the dealership. Or when she pays me back and I repay this loan, I dug a little hole in the death benefit and now I'm filling it back in. And that's going back to them, to my wife and my daughters when I pass. So people call this the Rockefeller method, like the elites, like whole life insurance. The banks and financial institutions own this by the truckload. You can read a book called Pirates of Manhattan by Barry James Dyke. He walks through what's on the books of every bank, major corporation. They all have this by the truckload because this is a secured. If you look at the balance sheet of a company, they have different tiers of assets, right? So like gold, hard money, U.S. Treasuries, and whole life insurance cash value are tier 1 assets.
Okay.
Because they like that is the most stable. And so if you ask the question, like if you ask most people, and people don't like whole life insurance, why is it on the asset side of the balance sheet of every single bank you work with? It's because it's a tier 1 asset. And so what we're trying to do is just do what banks do. The Rockefeller method.
Yeah.
There's another book by Garrett Gunderson called What the Rockefellers Do. Every time a Rockefeller is born, the family trust takes out a life insurance policy. I just put policies in force on 2 twins. So you can get these policies when you're 2 weeks old. Every time a Rockefeller is born, the family trust takes out a policy on those children. They can use it, access it during their lifetime for certain things, like the trust spells out education, business ventures, investments, wedding. Like there's categories of what you can access the cash value of the family trust is, these policies. Every time a Rockefeller dies, a huge bomb of tax-free money goes into the Rockefeller family trust. By 3 generations from now, like my daughters both have policies. When they're my age, their cash value guaranteed is higher than my current net worth. When they and the reason why I love children's policies so much is because you have such a long time horizon. When my daughters are retirement age, they're going to have a huge nest egg of tax-free accessible cash that they can use. So what I did was removed from my daughters the ever facing that choice that I faced, that a lot of us faced, of, hey, am I going to cave on my convictions in order to keep for this financial carrot that's dangled in front of me? They told me you're going to get court-martialed. They said, we're going to make you repay flight school, millions of dollars. They said, we're going to take back your bonus. That's the one they actually did. But they threatened all of this stuff. They took my monthly fly pay. They sent me to a punishment tour in Virginia on the other side of the country from my family. Like they did all that stuff, right? And it was either I could take the shot and avoid all of that, right? But I've removed from my daughter's futures ever having to make that decision because they will have this pool of guaranteed capital that they can access. And, it's so powerful to put this generational wealth into effect because every single client I've ever worked with, hundreds now, says the same things. They say, I wish I'd known about this earlier.
Yeah.
And that's because, the best time to plant a tree, right? So like I look at policies that have been in force for 10, 15 years and the dollar in versus dollar out as far as cash value growth. Again, this is too in the weeds for this discussion, but the way we structure the premium on these policies, we get cash value growth so early. And like I've paid 3 premiums into my policies. I have 3 rental properties and a real estate syndicate that I invested in. Those things are all cash flowing. And the interest that I'm paying to the company, which again, I don't have to pay those loans. I'm the banker. I control the terms of that. I am repaying my loans.
Yeah.
But what
now,
I'm paying in interest.
How does that work though? I'm kind of confused on that particular issue there about the interest. So first of all, how would let's say we'll go back to the auto loan analogy. Like how does the interest compare that you're having to pay to ultimately to the insurance versus to, like, let's say you were to take an auto loan at a dealership.
Yeah, they're going to look at the each company has a little bit different formula, but primarily it's based on the 10-year bond fund. So they're going to look at the Moody bond fund. Essentially, that's like the benchmark cost of money, right? And that moves up and down. So there's like market forces. The Fed is determining indirectly those rates, but whatever the Moody bond fund rate of return is, or cost of money, the interest rate on that is what they're trailing. So generally they trail that. So right now that's been rising. So, right now I can get a policy loan at 5%, even though the cost of money on the market, the property I'm closing on right now is at 7%. We're not talking about arbitrage here. People really try to dive in, kind of squeeze out arbitrage. We're not talking about a rate of return. We're not really focusing on that. We're talking about protection and savings. And from there we grow, but people always want to dive into the specific numbers. But to answer your specific question, the interest rate for a policy loan is going to be trailing the market rate of money, or the market cost of money, which is measured with a formula based around the 10-year bond fund, or the 10-year bond index. Sorry.
So then the other part that I guess, so you say you don't, there's like not a monthly payment that's due or a penalty or if it impacts your credit, right? Let's say you just go like 6
This is
months
all
without making a
outside the
payment.
credit. This is not.
It's all okay. Cool. See, that right there is appealing. That's interesting stuff. Yeah, that's cool.
Yeah. So like you have kids, if they apply to college, if they're going to go that route, I think a lot in our community aren't really interested in that. But when you apply to college, you got to apply for the FAFSA stuff to see what you would qualify for financial aid. This is not listed on your balance sheet that the government can see. Policy loans are not listed on your debt to income ratio if you're taking out a mortgage. Like, we are removing our wealth from
that's a huge
what we call
point
statement
right
wealth to contract wealth. It's outside of the purview of of a lot of the places where the government can look and evaluate us based on our outstanding debt, et cetera. This does not apply here. And again, all of these things I'm talking about, because the death benefit's tax-free, which is because it's not making you income, it's just replacing a loss. Because that's tax-free, access to cash value now is tax-free. The policy loan is tax-free. The dividends that we get each year are tax-free. When we interact with this policy, we are not dealing with taxes here. And this is not like a loophole. This is the tax code. Because for the same reason, like, I took a tax law class as an elective, like a cross school elective at Harvard Law, because I just really wanted to inflict pain, mind-numbing pain on myself. I thought it'd be super interesting. It was a lot more just case study, like, here in 1968, this, what should the tax be? Whatever, like a lot of Supreme Court cases and stuff. It was pretty dry, but I got to ask the professor a lot of questions. And the tax code is thousands and thousands of pages, but it's like, it's like 30 pages on what is income. The rest of it, the other thousands and thousands minus 30, is how to avoid it, right? So the tax code is just a roadmap of behavior they want to incentivize. So right now they want people with solar panels, and so you get a tax incentive for that, right? And but what's one of the most tax advantage things you can do is real estate. That's why I'm trying. I am not against investing. I'm not against growth. I don't want my clients to think that. I don't want people listening to think that we're just shitting on the CFP model because we don't believe in growth assets. We do. But the order of operations matters. What does this nest egg mean if it can be wiped away with a lawsuit or a fire? What does, if you get fired and you can't put income into these investment vehicles, what is your family going to live on? Do you have enough saved that you're not going to have to liquidate these investments? Once we have the protection and the savings boxes checked, and we have kind of a strong foundation for our castle, we built the moat around it. Then we go out and venture and take risk. I'm all about taking risk. I'm all about growing, and I'm doing real estate personally for that, because it's the most tax advantage vehicle you can access, apart from whole life insurance. And the reason is, again, like, it's not a loophole that you get depreciation on a rental property. It's just the government can't house everyone, so they incentivize people to become property owners. Same thing with this. They can't provide for everyone's retirement. And of course, there's a lot of thoughts on, the malintent, et cetera. I get all that. But like, at the end of the day, the tax code is written in such a way that it highly incentivizes permanent life insurance. So we kind of approach this from that protect, save, grow mentality. And I know all of the questions come on the growth side of it. How do I use a policy loan? What is the interest rate on the policy loan? Could I do better in the market? It's like, the questions always start there.
Mhm.
And once you've developed an understanding of the problem, which is that we have an abysmal savings rate and we're highly underinsured as a country, and we have very low financial literacy. Like once we address some of the root things, that's where people then focus once they get it, because people get their first policies, they get a little bit of proof of concept, and they say, all right, this is a good, like, this is a warehouse for your capital. This is a
Yeah.
safe
Like versus a bank,
contractual
like instead of a
warehouse.
bank. Yeah. It's like
Right.
where are you going to park your money? Yeah.
Yeah. And like we all know bank runs, right? And we talked about the
Yep.
fractional reserve. Like that's
Yep.
because they don't have the money there. But an insurance company is regulated very stringently. They have to maintain 100% reserve of their current
Wow.
outstanding capital
See, that's
requirements.
crazy. That's crazy. Like
Yeah,
that's
there's no such thing as
foreign
like a run
concept.
on the insurance company. If every
Yeah. Yeah.
policyholder said, "Give me my cash value right now," they have to have it.
Wow.
Now, if every insured died, the whole idea of insurance is that like 1 in 100 people at this age, at this health category, are going to die this year, but the other 99 are going to continue. Like it's just basic principles of insurance. But
Yeah.
if everyone died, like that is more liability than they have. So they have to maintain 100% reinsurance, where other insurers buy that risk. So it's like a layer of risk protection where you can't, like, no company, no American has ever been defaulted on in a whole life policy, because there's so many
Yeah.
levels of protection. Because again, it's a contract. It's not this like market risk investment. It's just a legal contract. And so because of that, it's treated very differently, stringently regulated, and it's not going to be defaulted on. It's a unilateral contract. Um, and I know that anyone listening probably has a lot more questions on the mechanics
Yes,
of a
exactly.
policy.
Exactly. Yeah. So here's
And
the
I
thing too,
can,
is like I've got like a lot more questions. I had some of my followers reach out to me with questions that they wanted me to ask, but I
yeah,
know
let's send them. I
well,
mean,
yeah. I know you got a family to get back to. Let's do another episode here soon, dude. I'd love to have you back and we could just keep the discussion going. If you're
absolutely.
down, I think that would be super helpful and beneficial. I would love to kind of have a chat with you offline, kind of go from there because this is appealing to me. And yeah, dude. But yeah,
I
I
mean,
know you got
if you got user questions, like let's throw one or two, and then we can.
well, so the two that I had was one of them was so in the event of like find like a dollar, like say just a total dollar collapse, like how is
Mhm.
this, would this be more or less protected from market forces? Like let's say there's like the whole US dollar just kind of rug gets pulled on that. Like
Yeah,
is how what would that look like?
yeah. I actually, it's funny. It's almost, if we hadn't just made this plan to do this interview a week ago,
Yeah.
I would have thought maybe you would teed me up with this. I wrote a little ebook. It's not even called I can't even call it an ebook. It's like 20 pages, but I
Yeah.
wrote an article that got longer and longer with my thoughts on this. It's called IBC and the Collapse of the Dollar. I will
Mm.
send it to whoever reaches out in the show notes.
Sure.
And I kind of broached at the beginning, like the idea of leaving a safe full of gold, or 20 acres of raw timberland or whatever. All of these things, if I'm listing all the assets I want as like a prepper for the collapse of the dollar, it's great to leave, food storage and raw timberland and a safe full of gold, but you're just going to have to convert that back to dollars. And so it gets
Yeah.
back to that idea of, I want to optimize in this fiat world that we're in. And I'm using that to, one, generate cash flowing incomes or cash
Mhm.
flowing assets that supplement my income. But two, I'm also buying gold. I have food storage,
Yeah.
water purification. Like I want all of that stuff. So I'm hedging the fact that like 100% of people who predicted the collapse of the dollar, that we're going to be Venezuela, that we're going to be, wheelbarrows full of money. 100% of people that have predicted that so far have been wrong to date.
100%.
Right.
Yeah. Oh yeah.
So how many people over the last 50 years have made that prediction, funneled everything into these assets, left their family, and they pass, and it's like, well, the dollar is still the world reserve currency. Now your family is like, what do we do? How do we get out of raw timberland? I don't know. I'm going to fire sale this, and I need cash. Like I need dollars, right? So I am going to operate under the assumption that when I die, my daughters will still need dollars to live their lives.
Yep. There you go.
If I'm wrong, then what do I have? I have these assets that were growing, this cash value is growing. I have these policies with
Yeah.
this large death benefit, et cetera. I have the dollars on lock. I can acquire in the meantime a safe full of gold, a
Yeah.
homestead, chickens. Like I'm going to use my policy to acquire those things so that I leave them both, the dollars and the hard assets, because I don't think my daughters are going to want a chicken coop and a safe of gold, right?
Yeah.
I want that, but if they're, whatever the situation is, like I want them to be able to maintain their life. And so I believe that I call it in my ebook, I call that like the parallel tracks of economic preparedness. I want to plan along the collapse route, but
Yep. Yep.
rather
Yep.
than, and it's the same thing, like going back to this, if I transfer this to a safe full of gold, if I transfer this cash to raw land, to a homestead, whatever, like I'm losing that forever. What if I can keep this on this track where I'm optimizing my dollars and at the same
Yeah.
time use that to leverage and
Dude,
build up these assets?
it's kind of like with me and like Bitcoin. It was like I remember when it was like 20,000, or no, it was like 10,000, went up to like 20,000. I'm like, okay, damn. When it goes under 10,000, then I'm gonna jump in big time.
Yeah.
And then it's like, and then when it goes to 20,000 to like 30,000, I'm like, okay. When it goes under 20 again, I'm still in that category. I'm like, okay, when it goes down to 20 again, I'll jump in. I'm like, dude, fuck. And then it was like
Yeah.
60, or when it was like 70, I'm like, okay, when it goes back to 60, I'll jump in. I'm like, it's like that same mentality where it's like we have to assume like we have to assume growth. I mean, that's like part of like the whole ethos of like Bertara is like we just like no fear, dude. We just push
Yeah.
forward no matter what. Doesn't matter. And so I like that. I mean, that's a really good answer because it takes into consideration that because you're covering all your bases, but then operating under the assumption that things are going to be great and that the grabblers will figure it out in the end, that they're going to figure out a different solution to swap it in and everything's going to be great because their money will go away too. It's not like, it's not like yeah, it's like this crazy bubble and it's not based on anything, but it's like, if it were to be a collapse, their money would be affected too. They don't want that.
Right.
So
And if you're worried about that, legitimately, and I have a client who is a big client, pays big premium into a big banking system for his family. His cash was all in gold. Like he was like, I'm going to liquidate some of this gold because I'm a full scale prepper, but I realize I'm kind of shortchanging my family if I'm wrong on this.
yeah,
And so you can prepare along both, you can optimize along
yeah,
both tracks.
totally.
And I think that's the way to go. And, you know, if, if, if we're worried about financial institutions, which we should be, banks collapse when there's a run on the bank. But like I said, there's no such thing as a run on
Yeah.
the insurance company. There's different layers. And that's a lot. There's more to talk about even on that. And that's a question we can go more into that next time. But it's
Cool.
like this is about controlling the banking function. This is about understanding and managing the flow of cash, because I know whoever's listening, I know two things about you. One, you're going to die. Have you matched that guaranteed event with a guaranteed outcome that's going to protect your family? The other thing I know about it is your money has to reside somewhere, right?
Yep.
I don't know who you are listening, but I know your money is somewhere. It has to be. And so we have to choose these vehicles and we have to take these things into consideration. So if you can put it in a vehicle that guarantees contractual growth, guarantees access, is outside of taxation, um, if you can build this castle and build the moat and then go do your investments and your growth from there while protecting your family, like, this just, we're plugging all these holes in the dam. And
Yeah.
because people don't realize, people don't think about the eroding factors that are always coming at your wealth. It's inflation, it's taxes, it's planned obsolescence, it's lawsuit liability, it's disability. So, we can plug all of those holes because this whole life contract has provisions for disability, has it's liability protected from claims. Like we are plugging so many holes by doing this. And we're still, there's a good book called The And Asset where, like I've said over and over, people always compare it to an investment. It's not an investment. People say, why would I do that? I could do this or I could do that. And the answer is no, you can do this and that. You can get a whole life policy that you use for banking, get that early cash value growth, and go do real estate and invest in your 401k if you want to. But you can do it to where you're removing your principal from the one-time use of money. And like I said, that article, the policy loan, I walked through my actual policy, the actual numbers. I have 4 different cash flowing vehicles that I've funded out of my whole life policy. The only out of pocket cost to me is the interest to the insurance company if I choose to pay it. I am paying it down. And by doing so, I'm just unlocking my cash value again to use it. As soon as I have enough
Yeah.
paid down, I'm going to get another property. Like my strategy, I now have to replace this pension that I planned on getting. And so I'm going to do that by acquiring rental properties. And so we just need to have a higher level of conversation where we talk about the control and the banking process, because that is totally omitted from the typical conversation. But I would love to do another combo and go into
Totally,
more
dude.
details.
I love it, man. This is good stuff. It's definitely got my wheels spinning, and it's just just realize I just realized I have a lot more to learn, and hopefully everybody out there is kind of just, if nothing else, take a look at your just where you're at in life, and just kind of just realize that there's more options of what we're being presented, because they don't want us to have the answers. They don't want us to have autonomy. They don't want us to have independence. They don't want us to take control over our own finances, our own health. Like, we know that. And so if there's any tools out there that we can use to help gain autonomy, step outside the system, the parallel economies, all that stuff, that's what we're all about around here. So much thanks to you, man. I really appreciate what you're doing and for coming on and spending your time and educating us with this. And let's definitely do an episode here very soon. But tell everybody where they can follow, support you, where they can learn more. Like, tell us everything.
Yeah. I mean, we have the remnantfinance.com. That is, you'll find links to booking a call if you want to talk more. You'll find a link to our blog there. You'll find a link to our podcast. So pretty much everything can be done from remnantfinance.com. You can email, yep, there it is. You can email me at hans@remnantfinance.com. Yeah, that's the website there.
Cool. And then, of course, go check out the podcast. They have lots of YouTube videos up there, and it's there's links in the episode description. I've already learned a lot, so I'm gonna be I'll be reaching out, dude. So I really appreciate you, dude.
Yeah, for sure. Yeah, I enjoyed it, man. I just consider the fact that if you've been misled in these other areas of your life, perhaps, just like the pharmaceutical companies control the syllabus at the med schools and they control, the ratings of the doctors. Well, maybe the financial institutions set the syllabus for the CFP, et cetera. Like, just think about who is incentivized from what you're currently doing. And if you don't like it, just open your mind, be willing to learn that, might be a better way.
Yep. Awesome, man. Well, I appreciate you very much. And you guys, thank you all so much for tuning in tonight. As always, good to be back doing interviews. I love it. If you guys like the work I'm doing, you can support my work. Subscribe to the rebunked.substack.com. There's actually a link below. If there's a give, send, go, it's like my tip jar, I say, if you get any value out of it. And then there's a bunch of affiliate links there. If you want to support your health and all your stuff, then links there. And of course, rebunkrecords.com. Go rock out. It's free. Just, you know what I mean? Like, just go have a good time rocking out. So, all right, Hans, thank you so much, brother. And we'll talk soon.
All right. Cheers, man. Thanks.
All right. Cheers. All right, everybody. I'll catch you next time. Peace.